Hello and welcome back to All Things Money. My name is David Blain, and during today's show, during this segment, we're going to be talking about the myriad of tax law changes that took place in the year 2010. You know, this time of year, people start to think about taxes and get done with the holidays. The reality sets in that they've got to get all their paperwork together and get over to their tax preparer and get their taxes done. And this year there was a ton of new rules. It was a big year for tax law changes. And at my firm, we do our clients' taxes. We have a lot of expertise in taxation. One of the biggest things, I want to give you some ideas. A lot of tax preparers out there have thousands of clients, and they may not know your particular situation very well. And this is a mistake I see a lot with your normal tax preparation firms, is the client expects the CPA to know all this stuff for the client. Well, frankly, they have too many clients to do that. Put in a quick plug for my firm. Because we only have so few people, we do, in fact, know the tax situation of our clients much more intimately. But the purpose of today's show is to give you some ideas. If you're with a regular tax preparation firm, you need to make sure you're prompting your tax preparer on some of these things that may apply to you. So the first thing we'll talk about, of course, is the big one, the impact on the individual tax rate. So on December 17th, President Obama signed a 2-year extension of the reduced income tax rates until the year 2012. Now, it's very... The way these things are referred, it's a tax cut, temporary tax rate, all these things. And what this goes back to is way back in 2001, the Economic Growth and Tax Relief Reconciliation Act was the beginning of all this. So when you hear about tax cuts being extended or temporary or things like that, it goes all the way back to them. And in the tax code and congressional lingo, these are all sort of temporary fixes, even though they've been with us for 10 years now. Anyway, so the big thing is it extends these lower tax brackets of 10%, 15%, 28%, 33%, and 35%, where previously and scheduled to go into effect in 2011, it was going to go to 15, 28, 31, 36, and 39.6. So breaking that down, the lowest tax bracket remains at 10%, where it was scheduled to go to 15. The highest tax bracket remains at 35%. It was scheduled to go to 39.6. A lot of the talk you hear is, tax cuts for the rich and, this sort of thing. And that's just patently false, because if you look at the lowest tax bracket, someone in the 10% tax bracket was going to go to the 15% tax bracket. That is a 50% increase in their tax rate. At the highest end, people were going to go from 35 to 39.6. That is a little bit under a 14% tax increase. So yes, it did benefit people in the higher tax brackets, but it certainly, to a huge extent, benefited people in the lower tax brackets as well. And it's something that needs to be said. Once again, this is a 2-year extension of these cuts. So automatically in 2012, if Congress does not act, the rates will go up. And that's an important thing to keep in mind when you're doing your tax planning. Also in 2012, higher income taxpayers are going to be hit with an additional 0.9% Medicare tax and the 3.8% contribution tax. So there's going to be some other changes in 2012 that affect higher income taxpayers. Some other good exemptions are things that were extended. The child tax credit remains at $1,000 for 2011 and 2012. It also extends the marriage relief, and what that has to do with is there was a discrepancy previously in the tax code that actually penalized people for being married as opposed to the two single rates, and so that was fixed. Capital gains and dividends. It extends the maximum rate of 15% capital gains, and more importantly, once again, this is where this really helps people in the lower tax brackets. The capital gains rate stays at 0% for people in the 10 to 15% tax brackets, and that's what I don't understand why people are always saying these tax cuts are just for the wealthy. This tax cuts help the lower income taxpayers tremendously. You pay no capital gains tax if you're in the 10 or 15% bracket. It also taxes qualified dividends at 15%. Once again, this affects both high and low income taxpayers, but a dividend was scheduled to be taxed at the higher ordinary income rate. It really hurts people investing and saving for their future or living on their income. The alternative minimum tax for 2011, it also bumps that up to $45,000. To $74,450 for married couples. So this is something that they have to fix every year. They have to keep raising the alternative minimum tax. I don't understand why they just don't put in the tax code some sort. Well, first of all, get rid of the alternative minimum tax. But if they don't do that, they patch this thing every year, and I don't know why they just don't have it indexed to inflation or something like that. Of importance to anybody out there that gets a payroll check, the tax relief reduced the employee's share of Social Security and Medicare from 6.2% to 4.2% for calendar year 2011. And it replaces this making work pay credit. This is something that, once again, benefits everybody. It benefits lower income taxpayers, high income taxpayers. I'm not sure that we really needed to do that at this point. I think keeping the tax rates were the same, but this was an additional tax cut that I'm not sure we needed to cut. As I showed in the first segment, Medicare is in serious problems going forward, and so I'm not sure we needed to do this. Of course, I'd like eventually to have it eliminated completely, but at this juncture, I'm not sure. Well, there's a lot more changes. I've probably got 2 or 3 more shows worth of changes of taxes. So tune in next week and we'll continue talking about some of the tax changes that happened in the year 2010. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.